Hello everyone and welcome to the CryptoBooks webinar, Crypto Tax Guide for Portugal. My name is Adriana and I'm a specialist in cryptocurrency taxation. Today, we'll walk through the complete fiscal landscape for crypto investors and professionals living or operating in Portugal. This session will help you understand your tax obligations, how to report crypto activities properly, and, most importantly, how to simplify that entire process using CryptoBooks. Whether you are a casual holder, active trader, or blockchain entrepreneur, this guide is for you. Let's get started with an overview of what CryptoBooks has to offer. First, a warm welcome again. I'm Adriana, and I'm specialized in the intersection of cryptocurrency and taxation, particularly here in Portugal. At CryptoBooks, our mission is simple: help crypto users report their activity accurately, efficiently, and in full compliance with the Portuguese tax law. We know this area can be complex and sometimes overwhelming, especially with the changing laws and different rules for various types of transactions. This webinar is your one-stop guide to clarity. By the end, you will know exactly what you need to declare, when to declare. This slide gives a snapshot of what CryptoBooks actually does. Imagine trying to manually track hundreds of transactions from multiple wallets, DeFi platforms, exchanges. It's wild. But with CryptoBooks, you don't have to. The system automatically imports all your data from exchanges, wallets, and even on-chain activity, and organizes it in a way that's readable and usable by the Portuguese tax authority. It uses the correct FIFO method for capital gains, recognizes staking income, and even classifies everything according to the law 24D from 2022. The result? Ready to submit IRS and DMIS reports with euro conversions based on official rates. No more spreadsheets or guesswork. If you haven't tried CryptoBooks yet, this is a great time to start. We are offering a 35% discount on all plans using the code V335, valid until August 31st. Even if you are just curious, you can create a free account, import all your data, and explore the platform without commitment. This is especially useful if you are unsure what your crypto tax situation looks like. Also, don't forget to subscribe to our channel for future webinars, updates, and tax tutorials. We are building a community of informed, empowered crypto users. Here is what we are covering today. We have structured the session into 4 key sections. First, we will talk about the new legal and fiscal regime, how Portugal went from being a crypto tax haven to having one of the clearest regulatory frameworks in Europe. Next, we will look at who needs to declare crypto and what types of operations are considerable taxable. Then, we will dive into the practical side, where to declare your income and when those deadlines hit. Finally, we will show you how CryptoBooks simplifies all of this with real tools and reports designed for Portugal's system. Let's jump into part 1, the new tax regime. For a few years, Portugal had a reputation of being a crypto tax haven. Between 2020 and 2022, there were no specific rules about how to declare crypto. No annexes, no enforcement. This attracted many investors and digital nomads. However, that all changed in 2023 with the passing of Law 24D 2022. Portugal moved to fully regulate the crypto sector, integrating crypto into the tax code with structured rules. Now, whether you are earning staking income, swapping coins, or running a validator, your activity is part of a normal tax framework, and you are expected to report. This slide gives us the why behind Portugal's legal shift. It wasn't just about revenue, it was about managing risk. Between 2020 and 2022, crypto markets exploded. Portugal saw record levels of trading, token issuance, and adoption, particularly among young investors and digital nomads. But with that growth came legal gaps, risk of fraud, and a lack of clear oversight. International bodies, especially the EU, began pressuring member states for more transparency and harmonized crypto taxation. That push led to a major reform in Portugal's 2023 state budget, aligning national rules with the broader Europe's framework. So, what we have now is a structured system balancing innovation and accountability. Now, let's break down the key points of the new tax regime. First, short-term capital gains, meaning crypto sold within 365 days are taxed at a flat rate of 28%. This must be declared in Annex G. If you hold your crypto for more than a year and sell it via a compliant platform, one that's based in European Economic Area, or a tax-restricted country, those long-term gains are exempt. But if you use a blacklisted or offshore exchange, that exemption disappears. Also, all calculations must use the FIFO method, first in, first out, which we will explain shortly. And finally, income from staking, mining, or business-like activity is taxed under category B or J, depending on the situation. And note, the regime regarding non-habitual residents is no longer available for new applications from 2024 onwards. This isn't just about taxes, it's about full supervision. Under the new rules, all platforms operating in Portugal must be licensed as VASPs, Virtual Asset Service Providers. These platforms must comply with transparency, auditing, and KYC obligations. That means your activity isn't anonymous anymore. Exchanges and on-chain tools allow the tax authority to trace and cross-check everything, even transactions from self-custodied wallets. Supervision is handled both nationally by CMVM and Bank of Portugal and at EU level through agencies like ESMA and European Commission. So, the bottom line, compliance is no longer optional. Reporting your crypto activity is now an integrated part of Portugal's tax and financial system. To wrap up part 1, let's revisit the big picture. Portugal used to be a low regulation zone for crypto, but with market growth, tax complexity, and European alignment pressures, that changed. The new legal regime formalizes how crypto is taxed, supervised, and reported. It doesn't mean crypto is discouraged. Portugal remains an attractive jurisdiction, but investors and users now need to play by clear, strict rules. This makes proper reporting tools like CryptoBooks essential, especially for those juggling multiple wallets, protocols, or earning passive income through DeFi or mining. With part 1 focused on the legal framework, let's move into part 2, what you need to do as a resident. Portugal defines tax residency broadly. If you spend 183 days or more in the country during any 12-month period, or if you maintain a habitual residence, you are a tax resident in Portugal, and you must report all relevant crypto activity. This includes digital nomads, freelancers, students, and even part-time residents earning local income. Important note, even if no tax is due, for example, if you only had long-term holdings, you still need to report. The declaration itself is mandatory, and failure to report can lead to penalties regardless of tax liability. This slide is absolutely critical. In Portugal, not every crypto action is taxable, but almost all of them are reportable. Here's what you must report. Selling crypto for fiat, like converting Bitcoin to euros. Swapping one token for another, for example, swapping Ethereum for USDC. Using crypto to buy goods or service, like paying a freelancer in stablecoin. Receiving crypto as income, including staking, mining, or freelance payment. Business activities, like running a node or issuing tokens. And the key point here, if a transaction results in a capital gain, expense, or economic benefit, it needs to be declared in your Model 3 return, even if no tax is ultimately due. In Model 3, Portugal's individual tax declaration, you will report crypto activities across different annexes, depending on how the income is classified. Let's break it down. Short-term capital gains, sold within 365 days, these go to Annex G and are taxed at 28%. Long-term gains held more than 365 days, these may be exempt if sold via EU, EAA, or treaty-based platform, but still must be reported in Annex G1 for transparency. Staking and professional income fall under different annexes, which we will get there soon. But the big takeaway here is Tax classification depends not only on how long you held the asset, but where and how you transacted it. Okay, this slide is where the things get technical, but important. Short-term gains are taxed at a flat rate of 28% under category G. If your total income exceeds 72,834 euros, you will be subject to aggregation, meaning your gains are added to your income and taxed progressively up to 48%. Long-term gains are exempt, but only if the sale happens through a platform based in Portugal, the European Union, the European Economic Area, or a country with a double taxation agreement. The exception doesn't apply if you use the blacklisted platform, but we will talk more about it later. Also, there are solidarity surcharges that vary between 2.5% and 5%, which can apply for high earners. So, depending on your overall income, the tax bill could rise significantly without careful planning. As mentioned, Portugal maintains a blacklist of jurisdictions considered non-comparative for tax purposes, based on Ordinance 115 from 2004. If your crypto transaction involves a platform or counterparty based in one of these locations, such as the Cayman Islands, Panama, or the British Virgin Islands, the long-term exemption is void. Even if you held your crypto for 2 years, you will still owe capital gain tax, and these cases are more likely to trigger audits or document requests from the tax authority. So, if you want the exception on long-term gains, make sure the platform is based in Portugal, the European Union, in the European Economic Area, or in a country with a double taxation agreement. Also, CryptoBooks helps to track these jurisdictions and flag risk areas in your transaction history. FIFO method. Portugal mandates a strict FIFO method for calculating capital gains on crypto. That means the earliest coins you acquired are considered the first ones sold, no matter what platform or wallet they came from. Each disposal is matched to the oldest acquisition. This creates a unified chronological ledger. Let's say you bought one Ethereum in 2021 at 1K and another in 2023 at 2K. If you sell one Ethereum today for 3K, FIFO method means that 1K cost basis is used, giving you a 2K gain. Also important, transaction fees tied directly to the acquisition or disposal can be deducted. However, capital losses can't be applied to other income, but they can offer future gains for up to 4 years. So, tracking them matters because you can offset those future gains. This slide addresses a common point of confusion. Moving crypto between your own wallets or accounts is not a taxable event. Whether you are moving assets from Binance to Ledger or bringing tokens from Ethereum to Polygon, as long as you maintain the ownership and control, there is no gain or loss to declare. But this is important. You must classify this correctly. If an internal transfer is misinterpreted as a disposal or swap, it could trigger a false tax obligation. So make sure to keep documentation showing ownership of the sending and receiving addresses. Clearly tag internal transfers in any portfolio tracking tool, and avoid triggering audit flags by maintaining clean records. Also, CryptoBooks helps automate this classification, minimizing errors and ensuring your tax reports reflect the true nature of each transaction. Crypto to crypto swaps must be declared. This one surprises many users. Swapping crypto is a taxable event in Portugal, even if you never touched fiat. Trading Bitcoin for Ethereum or Ethereum for USDT, whether on centralized exchanges or DEXs like Uniswap or Jupiter, count as a disposal of the original asset. Here's why. The law treats a swap as two transactions, a sale of the original token and the purchase of the new one. You are taxed on the capital gain realized on the original asset at the time of the swap. Declare this in Annex G if the platform is based in Portugal, European Union, European Economic Area, or a country with a double tax agreement, or Annex J if it's a foreign entity. This is another area where automation helps, and CryptoBooks identifies swap operations and automatically calculates the gain based on FIFO rules. Spending crypto for payments isn't just a financial decision, it's a taxable event. Under the Portuguese tax law, using crypto to buy anything, whether it's services, products, or donations, is treated as a disposal of an asset. You are taxed on the capital gain calculated using the token's euros value at the time of the payment. Example, paying for freelance services in USDT, using a crypto debit card, donating crypto to a DAO or a no profit. The gain is calculated as the euro market value at payment minus the FIFO acquisition cost. This should be declared in Annex G for domestic or European Union or European Economic Area, or transactions happen between a country with a double tax agreement, or Annex J if the country party is based outside those jurisdictions. This is one of the reasons why many users get blindsided by tax bills. So educating clients and automating these declarations is key. As you know, DeFi is booming, and so are the tax rules around it. But let's break it down. Staking rewards when received 15% of the euro market value is considered taxable. These go into category B as self-employment income and are declared in Annex B or J, depending on platform jurisdiction. Lending or yield farming, these are taxed when the reward tokens are sold or swapped. The kicker? Their acquisition cost is considered zero, so the entire sale value is taxable unless you held them for over 365 days. Important, if you are regularly interacting with DeFi, especially through DAOs or protocols like Aave or Curve, it's essential to keep proper logs, and CryptoBooks handles this via read-only access to your wallet. Airdrops are seen like free money, but they come with tax strings attached. There are two main taxable moments. At receipt, the market value in euro is considered capital income and reported in Annex G1. Your acquisition cost is zero. And at sale, if not declared at receipt, the full sale price becomes the taxable gain, declared in Annex G or J. Also, if the airdrops are structured, repeated, or connected to activity like node running or marketing, they may be classified as professional income under category B. In those cases, you declare them as a business income and use codes such as 419 or 422 depending on the type of crypto activity. CryptoBooks identifies and flags this based on-chain behavior, saving hours of manual work and helping you avoid costly classification errors. Portugal distinguishes between casual investors and professionals when it comes to crypto. If your crypto activity is regular, structured, or profit-orientated, it falls under category B, that's self-employment income. Examples include mining, solo, or pool, day or swing trading with high frequency, operating validator nodes, issuing tokens, or managing DAO treasuries. This income is taxed progressively from 13% to 48%, depending on your annual earnings. If you are in the simplified regime, only a portion of your revenue is taxable. For example, mining is taxed on 95% of gross income. Also, once your turnover exceeds 200K, organized accounting becomes mandatory. So, if you are deep in the ecosystem, this slide marks a shift from investor to entrepreneur, and the tax implications reflect it. Now that we know professional crypto activity falls under category B, let's talk about how to declare it properly. Use Annex B for activity on platforms or clients based in Portugal, and Annex J, Table 6A, if the income is from foreign entities like Binance, Ledger, or DAOs. And these aren't generic declarations, they require specific codes. Code 419 for general crypto operations such as staking services, or code 422 for mining, solo, or pooled. Each declaration must include the platform or the protocol involved, gross income in euros, time periods, especially if long-term holding affects classification, platform jurisdiction. Beyond capital gains and income, there is one more tax recover, imposto to sale or stamp duty tax. In Portugal, two types of crypto operations trigger stamp duty: commissions paid to service providers based in Portugal or with a local branch, and this includes both explicit fees like trading fees and implicit costs like slippage, and a tax rate of 4% of the commission amount. There is also free acquisition of crypto assets like airdrops, gifts, donations, or inheritances, which is taxed at 10% if the monthly value exceeds 600 euros. If you are below the threshold, you may not own tax, but you still need to report it via the stamp duty form. Now, let's talk about the deadlines for stamp duty. You must submit the stamp duty declaration separately from your IRS declaration. And the deadline is strict, by the 20th of the month following the taxable event. If the 20th falls on a weekend or holiday, it rolls to the next business day. Even if the tax due is zero, like you receive only 500 worth of airdrops, failure to file the stamp duty can still result in fines or audits. CryptoBooks handles this by calculating the taxable value of commissions in free crypto, generating the official stamp duty reports, and notifying you of upcoming due dates. This keeps you 100% compliant with Portugal's crypto-specific tax reporting. This slide summarizes everything we have covered so far, so let's walk through it line by line. Short-term gains, which means hold for less than 365 days, are taxed at a flat rate of 28% and are declared in Annex G. Long-term gains, which are the ones that you held for more than 365 days, they are exempt if compliant and declared in Annex G1. Staking, lending, DeFi rewards, tax on receipt or disposal, Annex B, Portugal, or Annex J if foreigner. Professional activity like mining and trading are self-employment income and are declared on Annex B or Annex G if foreigner. Stamp duty, which the tax rate varies between 4% or 10%, applies to commissions and gifts and is declared monthly via stamp duty declaration. And remember, reporting is mandatory even when no tax is due. It's not just about what you owe, it's about being visible and compliant in the system. This wraps up part 2. Next, let's get practical, showing exactly when and where to declare everything. Let's break down the annexes. As I've said, Annex G for short-term capital gains. You hold them for less than 365 days. Annex G1 for long-term capital gains. Annex B for staking, mining, or professional crypto income. And Annex J for every time that your earnings come from a foreign platform. There is also the stamp duty that you have to fill outside of your IRS declaration and covers commissions and also things that you receive for free in crypto. And you ask me now when to declare. So your fiscal year comes from the 1st of January until the 31st of January. This marks a fiscal year, and you need to submit your IRS declaration between the 1st of April and the 13th of June. After this, you have the obligation to pay if there is any tax due until the 31st of August. Additionally, every month until the 20th, you have to submit the stamp duty form. But how does CryptoBooks can make everything easier? CryptoBooks is specifically designed for the Portuguese tax regime. After everything we have covered, the legal changes, tax obligations, annexes, and reporting schedules, the question becomes, how do you actually manage all this without losing your mind? That's where CryptoBooks comes in. It's built specifically for Portugal tax regime. You don't need to manually enter transactions or calculate FIFO gains by yourself. CryptoBooks does it for you, securely importing transactions from your wallets and exchanges with read-only access, no private keys, ever, applying FIFO automatically, classifying income correctly for the Portuguese tax authority, converting all the amounts to euros using the Bank of Portugal official rates, and producing pre-filed reports for your Model 3, which is IRS declaration, and also stamp duty declaration. This turns what would take days or weeks of manual effort into a few clicks. CryptoBooks is like your personal crypto tax assistant. It prepares every annex you need for IRS submission. Annex G for short-term capital gains, Annex G1 for long-term capital gains, Annex B for domestic professional income, and Annex J for foreign sourced income. And it does not stop here. Every month, it also generates the stamp duty form, which means you will never miss a deadline. You are always using the correct reporting codes, and your declarations are formatted exactly the way the Portuguese tax authorities expect. This level of precision minimizes audit risk and removes guesswork from crypto taxes. On top of the official forms, CryptoBooks gives you comprehensive documentation that backs up every number. You will receive a balance report showing your portfolio across wallets, a capital gain report with FIFO calculations, a fee and commission report for deductible expenses, a complete transaction story for perfect transparency, an income report categorizing everything from staking to airdrops, and a technical note explaining how each figure was calculated. These reports are essential if audited. Applying for financing, or just want a crystal clear record of your crypto activity, and they are automatically updated every time you sync a new data. If you haven't signed up yet, now's the time. CryptoBooks is offering a 35% discount on all plans with the code V335, valid through August 31st. Even with a free account, you can import your transactions history, run a tax preview, identify which annexes you need, and detect errors or misclassifications before filling. It's a risk-free try, and for many users, it has literally saved hundreds of hours in spreadsheets and manual math. We also encourage you to subscribe our YouTube channel for tax tutorials, law updates, and product walkthroughs. Thank you for joining us today. We know that crypto taxes can be overwhelming, especially in a fast-changing environment like Portugal. But with the right tools and the right knowledge, you can stay compliant and avoid penalties and keep more of your gains. To wrap up, visit cryptobooks.com to explore the platform. Use the code V335 for your 35% discount. And don't forget to subscribe and follow us for more updates.